Hi, I'm Kevin McPartland, Senior Analyst with TABB Group. Derivatives reform seems to change daily, and I'm going to provide a little bit of an update as to where we are and what we should expect in the next couple of weeks. We now are set with a December timeline for the House of Representatives to vote on derivatives reform and broader financial reform. If it passes in the House by the end of the year, it will then go to the Senate, and we're hoping that by late in the spring of 2010, we will have passed derivatives reform sent to the President for signature. Now, there are a lot of things that could get in the way in the meantime. First, I think what we need to talk about is the differences between the House and the Senate. About 2 weeks ago, Senator Dodd and the Senate Banking Committee released their draft for financial reform. The draft bill was about 2,000 pages long, so in case you haven't read it all, it encompasses not only derivatives reform, which is the focus of this discussion now, but also broader financial reform. There are a few points in the Senate bill that are different from the House bill. First of all, the Senate bill talks about trading standard derivatives products on exchanges. Now, in the House bill, we talked about registered execution facilities, and there is quite a difference there. If we use the word exchanges only, that leads us back to traditional exchanges in the listing model, which would bring us to listing OTC derivative contracts as futures, for example. In the past, that hasn't worked. The CBOT, for example, has interest rate swap future contracts that do very, very little volume. So it's important to note the difference there. Swap execution facilities, as they're called by bills in the House, would allow for registration of the venues and more transparency into the trading without the exchange model that doesn't seem to suit these products. Secondly, there's been a lot of debate as to who should decide what is standard. We've been talking about the definition of standard since back in the spring, and although we've gotten closer to what that means, there's still some outstanding issues. Chief among them is who should decide what should be cleared. The House has gone back and forth whether it should be the clearinghouses that decide or the regulators that decide. The latest seems to be somewhere in between. The Senate bill states that both the clearinghouses and the regulators, the CFTC and the SEC, should work together to decide. It's important to note that it really needs to come down to the clearinghouses. They need to be comfortable clearing the products so that they're not putting themselves in a situation where there is more risk. And if there's risky clearinghouses, we're creating a new systemically risky situation, and that's not something anybody wants. Now, it's important to note as we approach December and the holiday season, there are many, many deadlines set in the derivatives world that are worth noting. First of all, buy-side clearing is expected to be available on many of the CDS clearinghouses and interest rate swap clearinghouses by December 15th. We also expect to see the CME CDS clearing venture in the United States live by December 15th, and all indications say that that is on track. There are also a number of deadlines set by the dealers, some which we have recently passed at the end of October, to centrally clear 95% of all new eligible CDS trades to a clearinghouse, along with others for interest rate swaps and equity derivatives. So there are a lot of deadlines in December, and whether or not we meet those deadlines will be very telling as to the progress going forward. But most importantly, it comes back to the legislation. The market can't get moving again until this legislation is passed and set in stone, so the businesses, market participants, they know what they're dealing with and they know how to rework their strategies. So let's hope that we can see something passed in the House by the end of the year and in the Senate next year. Now, we still have healthcare reform that can get in the way. We have elections in 2010 that can get in the way. And if the past financial reform that includes derivatives is all-encompassing, looking at consumer protection, for example, and the systemic risk regulator, discussions are going to take much longer as there are many more details to be ironed out, even beyond derivatives reform. So that's it. I'm Kevin McPartland, and thanks for watching.